is Jonathan Camarda, Chief Investment Officer, and how things have changed since the last time we've seen each other here. The market has certainly flipped on its head. Now, this is not out of the norm seasonally. We talked about, right, on last recording, that early July, that the market is constructive. We have bullish trends, and that held through to a T. Late July, things got choppy, and we saw that. And August, of course, is a coin flip as we enter the more volatile time of the year. So we've seen this record play many years, and as such, so never really a surprise, except the actors or the culprits sometimes change. So what we saw first was the rotation, right? You heard about it all in the news. Small caps finally woke up, started to outperform large cap growth, right? The Mag 7, the companies that were dominating the market, lifting it up and as such, and we saw that reverse. Now, again, while small caps were certainly beaten down versus large caps, there was only so much upside for them, because if you look inside the Russell 2000, it is essentially a kennel from a fundamental standpoint. In other words, 1/3 of the companies in the Russell 2000 are actually non-profitable. That means they have parentheses, negative net income. So there was so much air in that balloon. And what we've seen more recently, however, is that all equities within the growthier or overvalued spaces certainly get punished here. We've seen it through earnings seasons with individual equities, even in the tech space, certainly in the tech space where earnings were good. You know, they reported a good report card, but they have failed to and would not actually forecast a year in advance because of some of the weakness that's out there. But we're getting to the Fed, don't worry. We're going to get to your Fed watchers. We're going to certainly get to Uncle Jerry and such there. But first, again, so what we've seen is severe punishment for some of those companies, which we won't name, that certainly have been walking on that tightrope from that standpoint. Now, what we've seen and we've talked about, and as we get a little closer to the Fed here, is the employment data has really shown itself to be the 100-pound weakland at the beach midsummer. If you're on vacation, hopefully trying to enjoy, not worrying, let us worry. But from that standpoint, what we've seen, okay, is employment just really starting to sink. And the problem is the Fed. Now we get into the Fed. Here we are. All right. Has been using a lagging indicator, which means this is an indicator you look back on, not to guide you like a GPS. And what they've now found themselves is in the grizzly maze from an economic standpoint without any protection. In other words, they did not reduce rates. They had an opportunity this week. They said it's more probable in September. Of course, they still wouldn't commit. And what we've seen now is an unraveling, because the market, especially the bond market, that's where the geniuses are, have already sniffed at the fact that they are so slow on the fastball, just like they were going into inflation, transitory. Now they're slow on the other end, because employment can unwind pretty quickly, and you're starting to see that. We saw numbers this morning. This is Friday, August 2nd. Who can keep track? And we've seen that. So now what you've seen is the bond yields dropping like a rock, like we've started to maneuver into some of the longer duration bonds. We'll get to the yield curve here. And you've also seen defensive sectors, healthcare, utilities, financials, and real estate starting to outperform the market from that standpoint. They usually do well in times of volatility as well. So where we are is the Fed is now, no pun intended, behind the curve. They're gonna go in September. Some think 50. Some are even talking another 50 basis points in November. The timing of this is quite interesting here. But, you know, again, we shall see, as they're going to probably end up playing catch up again. So where markets are, right? Well, markets, again, we've had a nice pullback, nice being a healthy one. S&P 500 dropping low. Its 50-day moving average above the 200-day moving average for you technicians at home. NASDAQ, the same thing. 200-day moving average is not too far off. So while we are looking to trim in some strategies, we do want to see if we have that support there. Again, market's still near tops, near highs here. And again, that washing machine starts to rumble a little bit. People get worried, but, you know, you have to see how the wash, plays out there. So we're trimming and making moves based upon what we're seeing and in anticipation as well. And so when the Fed looks into the fall, employment's already starting to unravel. So the soft landing, I'm really starting to doubt it. And you guys, gals, might have already known that, but we shall see how that plays out from here, as they are now running behind. And everyone kind of knows it now. So what is the playbook for this, right? So we already talked about what we're doing is we're going a little bit longer in the yield curve. You know, we've talked about the inverted yield curve, right? That's where the 2-year is higher than the 10 and the 30 and all that. Well, things that got jumbled up. The 30 year, believe it or not, is now higher than the 2 year. So we're seeing what they call steepening. That's when the long end normally is higher than the short end, where you're getting paid more for the longer duration risk there. And the 10 year is creeping right up. 2 and the 10 years are in the upper threes, right? No more in the upper fours for the 2 year, and the such there. So as we start to see that reversing, you're starting to see some normalization there. But nonetheless, with rates going down, employment looking dour, recession, you can smell it. You can smell it. Hopefully, you have one of those bear stares because you can see the recession coming. Now, for equities, technology's had a healthy pullback. Some of the valuations for stocks, again, I won't name in particular here, look more attractive from that standpoint, but we do have to make sure that they're not getting thrown out with the baby in the bathwater to make sure, again, that we don't have more shaking out to do. What we're looking right now is constructive opportunities in the aforementioned sectors, healthcare, utilities. We've already seen it in opportunistic growth and income. Not that it's helping that greatly in a day like today, how could it? But certainly where we were adding more to some of your dividend payers, more of your value stocks on a large cap basis, which through the shakeout here for the last week and change has been the best performer, taking that baton from the woeful small cap sector from that standpoint. So that's what we see. We see bonds, especially on the longer duration, getting more attractive, adding exposure there across even tactical strategies. We see value stocks, good dividend payers, boring companies looking pretty good. Not the boring company. We don't usually talk individual stocks, but boring companies outperforming some of your high flyers, and certainly not giving up necessarily, but just repivoting and sculpting those hedges in some of the high flyers until proven otherwise. If we go into a full bear market, those are in 2022, that we didn't own a lot of any of those. Once we know that we are certainly in the Grizzlies' den, so not even close to that right now. Again, just keep your seatbelt adjusted, keep that tray in the upright position as it is a little choppy, and we will continue to watch. Now, speaking of choppy, the other thing I was going to mention is the dollar, and of course, as rates drop, right? You guys know you. Your economists at home, dollar's going down as well versus the euro, the pound, the yen. It's up versus the Aussie, New Zealand, and the such. But for the main currencies that it goes up against, weakening with yields from that standpoint. So again, very interesting times from that standpoint. We are starting to get slightly more defensive, as we mentioned. Again, we're only midway through the summer down in the south. Kids going back to school up north, still got a little bit more time, and such. Out west, I don't know, but it's midsummer, and this is what happens. Volume is generally lower because a lot of the professional institutional traders are on the beach somewhere, which means just a little rocking can cause a whole lot of noise. So again, just buckle up. Tray in the upright position. We will make maneuvers. If you have any questions as it pertains to your individual risk tolerance, certainly your personal wealth advisor and you can converse. Same thing with my clients, and from that standpoint, who again are acclimated with adjusting to that F1 track as it turns, not getting too jittery, but just making prudent maneuvers along the way. So again, we will stay eternally vigilant. You stay frosty, and until next time, Jonathan Camarda, want to make sure that belt is pretty tight and the hands are on that steering wheel. Till next time.